Right.
The reason we have number 6, 5 prior, 5 coming up is it's right in the center of what you all face, taking an idea and trying to make it into a viable business that has exit potential or has impact potential. And it's financial modeling that then enables you to fundraise. So without money, you won't be able to build your natural gas generators. Without money, you won't be able to capture your ethylene. You all do what again?
Micrograded software.
Pardon?
Micrograded software.
Software. You need less money for that.
Yes.
Yes, you can be more efficient, but then the upside is also, well, it can be great, but it's usually less. And the competition is, the barriers to entry could be much lower. So financial modeling is the very crux of your business plan. You represent, at the end of these 11 lectures, hopefully when you put your lecture number 10, we're going to have you present for 10 minutes. And I hope you've all gone back and looked at the lighter tech pitch.
Glance through, not take notes by going through section by section that we should have. But we'll do that.
I think you all should.
Yeah.
Because we'll get to, on November 1st, we'll also do pivoting, but we'll also do storytelling.
Yeah.
How to tell the story. And that's going to be critical because the story cannot be told without good financial models. So as always, I start off with just the agenda. So we're going to talk about how to develop a model. Anybody here very comfortable developing whole business plan financial model? You can do it. You can do balance sheets, cash flow, the whole thing. So you have an accounting degree?
Yes, my my background is accounting and finance.
Okay, so, but not every startup has the luxury of having someone like Luan Luan has all that experience. But again, you might have it from a more classical accounting perspective, but what does an investor look for? What do you as founders have to do in financial modeling? How do you forecast revenue? How do you analyze your burn rate? How do you figure out when you're going to run out of money? That's what we call it runway. And it's different for software. There comes Kumi. You were first up on the agenda, buddy. Did you do your 6, 7 slides? Did I have 5 slides? Did I ask you to?
USB drive. That's okay.
Cool. Well, at a natural break point, we'll have Trent. He's got 5 slides that he'll need to present.
Good.
Yes, in a little bit.
Okay.
Okay, as soon as we finish. So, and then we're going to do a real live case study of, remember I talked about the window cleaning robot that climbs the outside of great skyscrapers without ropes, cleans the windows, and so we'll actually see their financial model, what they have done, what they did to raise money, and what they're doing now because they're getting ready to go out for a Series A. And the modeling is very important. Time to say, I'm going to hire an accountant to do this. You as the founders, you as the co-founders need to viscerally understand your financial model because that is the fulcrum of your business plan, which is essentially your external representation of your business. And we'll come to the 9 components of a business plan. That's in the next lecture. Now, as always, I like to give you some life lessons that are relevant to this section. So combine asymmetric risk with exponential reward. What do I mean by that? What I mean is that the financial model should capture not only your rigorous PhD training, but also the audacity, or I call it the audacity of your entrepreneurial vision. So if there is, what does an investor look at? Sometimes you want to look at a safe bet where you say, okay, this looks fairly safe, and in 3 years I'll get a 3x return. Or you look at, hey, this thing could be either 50x or 0. And what are the odds? So the asymmetric return is also very attractive. So the fact that there's a high chance of failure, but look at the upside of success. That's what I talk about asymmetric return. Did you all understand that? So this is what I like to tell most entrepreneurs, because you can run up against brick walls. So don't calculate the odds of your dream. calculate the cost of not pursuing. Because if you fail fast, restart. But pursue your dreams. Another one like this. The correct action requires both grand vision and detailed calculation. That's kind of, I'd like to use a Star Trek. How many of you are Star Trek fans? Beam me up, Scotty. Nobody knows that expression. Where you're flying in space and you're on the ground. You can be there all at the same time. So let me give you an airline analogy. You're flying at 30,000 feet and you're flying at 30 feet at the same time. 30 feet, you're in the details. 30,000 feet, you have the vision. True entrepreneurs can do both. And the truth lies between reckless optimism and paralyzing pessimism. That's oftentimes you'll run into entrepreneurs who are recklessly optimistic with everything. Yeah, we can fix, we can do this. We're going to get the hockey stick's going to be great. You all know what I mean by hockey stick, right? Remember the Valley of Death? It's kind of like a hockey stick. You lose money, you lose money, you lose, and then suddenly magically you start making money, you come back out and it looks like a hockey stick. So hockey sticks for the really optimistic entrepreneur can be reckless sometimes. And for the really conservative type, you can be paralyzed with pessimism. Then you shouldn't go start your own company. You don't have that. Remember what I talked about, the risk gene in the first lecture, which is not a gene, but a virus, because it randomly infects you. Thank you, Ravi. Professor Ravi.
I was paying attention. Student.
So today's agenda, we'll do some financial modeling. We'll talk about fundraising and how do you go about fundraising. These are the various places you can raise from. And we'll see, why does financial modeling matters? Because the financial model is the plan for your company. And it answers most of what investors will ask. At least at a high level. When they drill down, they'll want to go into your data room and look at your various trade secrets or whatever it is you have that backs up what you're doing. But your financial model essentially is the face of your company. And it also becomes the vehicle for you to support your decision-making over time. When do you hire? Who do you hire? Which area? When do you spend the CapEx? When do you expand to new markets? So it's not just numbers. It is the fundamental tool to tell your story to the outside world. And if you can't tell your story to the outside world, what happens? You don't want to take a guess? You don't raise money. And then you don't get your company started unless you're fortunate enough to get the big SBIR grant like Kumi's gotten. But even for that, you have to tell a story in a different way to the government and people. And then, like I said, it's crucial. Your financial model is crucial for your strategic plan, also for fundraising, and for you to monitor. I mean, it becomes the tool, and you'll see when we go to the WC for robotics financial model, how you can play with decisions on the spreadsheet that are actual decisions that you make in real life. But this becomes a tool to help you, even with things like pricing and things like which new markets you want to. So, and why is it even more important for deep tech folks like you? For software folks, if you fail, you lost a couple $100,000. Two guys in a garage. Deep tech, the R&D cycles are really long. I mean, you talked about 5 years, and you've been doing it for 5 years.
Not exactly 5 years. That was a different project, but we outlined our project to go on the similar path. So it's a brand new project that we started, I guess, a year and a half ago.
So 7 years is going to be your project. That's a long R&D cycle. Most deep techs have regulatory hurdles. We'll talk about that the next lecture, which is all about legal and regulatory and IP. And you need a lot of money. $2 million just to, and I think you're short. You'll need more. Fundamental rule for entrepreneurs. It'll cost more and take longer. Whatever it is you think of, it's going to cost more and it's going to take longer. Just drill that into your head. And these challenges are what the investors want to test you on. That's why I said they would cost more. How much capital do you need? You need 2 million. Investor will probably say, probably need 5. Let me rerun the numbers with 5 and see if it's still viable. Because you're young, you're inexperienced, you haven't had the real life experience of doing this before. You've not converted a Nigerian diesel plant to natural gas yet. So you don't know those challenges. You haven't installed these superconductors, though you have piloted some. And so this is the fundamental conclusion of a good financial model. It not only communicates your vision, tells the story, but it also teaches you each step of how you execute. Because for me, as an investor, as an angel investor in lots of young startups, to me, the biggest risk is usually not technology risk. It's usually not even market risk. It's execution risk. Can you young folks pull it off? With all of the stuff that's going to come at you over time that you don't anticipate. That to me is the number one risk of a young spin out startup. It's execution. And a good financial model gives you some early indicators of where the risks might be. So the core elements of a financial model: revenue, cost, operating costs, and cash flow. I mean, it sounds self-evident, doesn't it? But I don't know how many people do it. How many people drill down to go into the detail and to figure out your costs, your burn rate, how much money you need to, when you need to raise it. Because most of you are terrified of dilution. You have to raise money. I now own 100% of the company. I might own only 60%. Well, remind you what I said in the first lecture. Professor of mine told me, remember, 50% of something is a lot better than 100% of overall. So these are the things that will constantly come to your thinking, and a good solid financial model helps eliminate a lot of the emotion and makes it very cold and calculated. So basic, how many units are you going to sell, or how much licenses, revenue are you going to get? What's the cost? How much is it going to cost to build one of your plants? Young man from Nigeria. What's your name again?
Collins.
Collins plant or Kumi's tape. What's the full cost? Have you estimated it correctly? What's your supply chain like? Have you figured that out? And then customer acquisition cost. You got to go out and sell it once you have the product. How are you going to sell it? You're going to do it with direct sales force. You're going to do it with distributors. You're going to do it with strategic partners. You're going to do it on the internet. How are you going to do it? And finally, what are you going to spend? Not just on people, but on travel, on CapEx, on everything else, on legal fees, on filing patents. So these are all important parts of the fundamentals of. So finally, you want to see, do you make money? Net income. Do you have a positive net income after the revenue, the costs, the operating expenses? Those are the 4 pieces when you really stand back and look at a financial. So these things are a good lead behind. How are you going to price your product? How do you plan to price your product? Haven't figured that out.
It's difficult, I guess, to put a price on that because it solely depends on the licensing fee.
So you're only going to license.
License it, that's the only way around.
So you know
As
how
I
to
mentioned.
So it's not difficult. You figured it out. You're going to get X% of what as the license fee? What is the top line measurement for the X%? Let's say you all agree, I'm going to get 5% license fee. How do you get it? How are you going to calculate it? All of that has to be figured out. In your case, you're just going to sell tape, right? For X dollars per foot. And it's going to cost you Y dollars per foot. Hopefully X is greater than Y. Not always the case. Don't laugh. And I've heard a lot of people tell me, I'll make it up in volume. Okay? If X is lower than Y, You'll lose more the more X's you sell. So all of this has to be figured out. And then are you gonna use direct salespeople? We talked about that. Are you gonna use partners? Are you gonna sell to the government? You, of course, have only 12 to sell to. And then these are all things that you have to look at, particularly in deep tech. So this is something that you all have thought through. Let me ask you, have you thought through all of this? You know what your product's gonna cost, you know what you're gonna sell it for.
Actually, our is unit based. Can be B2B.
The med tech, pardon? The med tech.
The medical device.
Yes, yes, so that's fairly straightforward. And you're still FDA cleared or not yet?
Not yet.
So there's a big variable there. What's it gonna cost for you to get the FDA? Because till you get FDA, all those costs are on you and charge the customer or the patient. So this is the final summary. And the cost drivers in deep tech, we all talked about is high R&D cycles, high CapEx. You're gonna have to do pilots. You're in the process of doing some pilots. You're far away from a pilot, right, Colin? You're not yet close. And then regulatory. That's going to be a big issue for almost anybody in deep tech, whether it be biopharma, whether it be med tech, whether it be energy, whether it be telecom, whether it be aviation, but some regulatory hurdle you got to cross. And sometimes major ones like the FDA. And then we know that the key component for any startup is your monthly burn. You all understand what monthly burn is? Everybody does? That's how much cash going out the bank. And it's everything, whether you're spending it on CapEx, hardware, operating expenses, salaries, office rent, buying laptops, flights, hotel rooms, whatever. Total of that is your burn. And that divided into how much money is in the bank is your runway. So if you're spending 100,000 a month and you got $1 million in the bank, you got 10 months before you run out. And probably more like 8 or 9. But the important thing about financial modeling, particularly for a lot of the uncertainty that all of your businesses will have, is not being very precise, not showing exactly, I'm going to run out of cash in 10 months, because as an investor, I'm saying, nah, it'll be 8, it'll be 7. It's showing that you've understood how to take it from where you are to where you intend to go. It's the thought process. And it's also what assumptions are you making? Because the easiest way to argue you run out in 7 months or 10 months is what are your assumptions? And those can be tested. If you say, I'm not going to hire any more people, but I'm going to triple my sales, that's an assumption that can be challenged. And all of that will be in your financial model. You don't have to write down a separate slide and say, I'm going to hire 3 salespeople in February and 4. It's right there on your spreadsheet. So you can do top down, bottom up. I don't like top down. You say, look, the market is 100 million and I'm going to get 1% market share in 5 years. So I'm going to do 1 million, whatever. That doesn't show the logic. Bottom up is far more credible for early stage startups. You got to say, okay, it's going to cost me $2 million. There's 500 such plants in Nigeria. I don't know. And I think that hiring 5 salespeople, and 2 consultants, I can get 1 plant a month. That's the bottom up. And if I want 2 plants a month, I'm going to have to hire 5 more salespeople, change the number from 5 to 10, and see whether it makes sense, or is it too much, too soon, too quick. And then you can play with your pricing. I'm gonna charge $2 million. No, I can think I can get away with 3. I don't know how you come up with your pricing. Have you been playing with pricing numbers?
Yeah, I mean, there's so many different strategies, but mainly it's tying with the market right now. Just so it's introduced at the same price as the market.
Okay. So you're better for the same price,
Right, but there's so many different strategies that we can. do, like,
but you haven't thought it through yet.
Yeah, we thought, but the main one is pricing at market price,
Okay,
even though it's has better performance and better margins.
so that's an approach. But again, bottom up.
Quick question. Most of you have taken some form of a class or two. What was the method? Because I remember your slides, majority of you did the
Top down.
top down. So this would be new information, right?
Yes.
Or
This
I,
is,
I think top down is really, particularly for startups, is an asinine way of going about it.
Hmm.
Because just say, I'm gonna get 1%, so what? Big deal. Is that how many units are you selling? Or how many software, your software as a service, right? So what's your annual recurring revenue? And how many do you need? For you guys, you've got the rule of 78s that work in your favor. You know about the rule of 78s, right? Anyone in the SaaS business should know the rule of 78. If you sell $1 new a month, you end up with 78 in the year. Because in January, it's $12, February, it's $11, March, it's 10, you add them all up. At the end of the year, if you just sell $1 a month, you end up with 78 in the bank. So that's the great thing about SaaS type of businesses is the rule of 78. You got the flywheel going, but to get the flywheel going, sometimes it's not easy. The startup cost can be quite high. Plus, competitors can really come in fast because barriers to entry are also lower. I mean, the barriers to entry for somebody like what he's doing is huge. Even what you guys are, barriers to entry are huge. So please, if you're gonna build a financial model, build it bottom up. And we'll talk in detail about it. And then look at various sensitivity analysis. I'm gonna acquire 1 plant a month in Nigeria. No, I'm gonna do it once every 2 months. And then rerun the model and see where you end up. Or no, I think by hiring more people, do 2 plants a month, whatever. And then play with churn in your case. Somebody signs up and then discontinues. The fact that they signed up doesn't mean they're gonna live with you forever, right? So the churn rate can be a big factor in your flywheel. And then can you reduce the cost? And we'll show you some of that also. Do a lot of what ifs. Like my robot that cleans windows. We've been delayed 4 years. But because we are prudent in the way that he spent money, we're still okay. Because we did all the sensitivity analysis. And the regulatory hurdles that causes some of the delays. And then finally, what if you need to pivot? We're going to talk about that in 2 weeks. So before we get into this case study, why don't we have, can we give us, what he did was he sent me his analysis of his customer discovery, the thing we did in lecture number 3, customer discovery process and how it helped you pivot from what you originally started with to where you've ended up now. So Trent, could we get him fired up, please?
Absolutely.
And then we'll come back to this slide.
and do share his slides on the Zoom too, okay?
If anybody else wants to tell their story next time on anything, please let me know. Love to hear more detail from you all about your story. What's anything that happened that you've learned here has applied to what you're doing. Like maybe next week we look at one of your company's financial models. You want to take that challenge for next week? Great,
Yeah,
you're
that'd
on.
be great, yeah.
You'll be the first speaker out before me. Your financial model for,
I'll find him an African VC. We can have some folks out of Dubai that would be. You may know, you have
yeah, but
friends.
right now, we don't worry about where you're gonna raise the money from. We're gonna worry about how much money do you need to raise and when. That's the start of the financial model. And what's gonna be your revenue? 5 years out, what's it gonna look like? We'll get to that.
Yeah, okay, so I think before I go into what kind of evolved out of the customer discovery, we're going to talk about what our thought process was going into it. So initially, this is a very academic way of thinking about things, but we initially believed that our higher performance was gonna be the main factor leading to sales. So that's where we started our target at when we were talking to customers initially. We only had we were in a special case where there's only about a dozen total companies that we can sell to or be like an effective.
Explain to them what your product is.
Okay, yeah.
Yeah.
Okay, so we manufacture superconductors. We found a way to do it at 3 to 4 times performance, at 10 times the throughput, and at 16th of the cost. So yeah, going into it, we initially believed that the performance increase was going to be the main factor driving everything. But due to customer discovery, as I'll get into, we had to shift that thought. So yeah, we initially believed that compact fusion and power transmission were going to be the fastest adopters, just because of industry experience. These are high performance tapes, they need high performance applications. Yeah, we initially thought that the customers preferred, higher performance compared to the other benefits of high throughput and low cost. So we did, 50 to 60 interviews, over 60 now, with people in fusion, transmission, everywhere, honestly.
These are nuclear,
Yeah, nuclear fusion.
just so that everybody understands. We're talking
Yeah,
about nuclear
compact
power
fusion.
generation.
Yeah.
Not gas.
And really, anyone we could get our hands on, people in the academic world, people in the business world, VCs, just anyone that has like a stakeholding opportunity, we want to reach out to them. And we went to a conference, went to Mag Technology in Boston, and that was really a lot of in-person discovery happened there, which I think was more valuable than anything, tenfold really. We'll get more into what happened because of the in-person discovery later, but we met with probably 30 to 40 different people, stakeholders, and we just back to back, and just getting as much data as possible to kind of collect your information. So yeah, we soon found out that the two things that we can provide solutions for, the things that we weren't targeting initially was actually most important to the customers, that being a limited global supply of HTS, of superconducting tape, and of the high cost of the current market. So we decided to revise our.
May I ask a question?
Yeah.
How much amperage and voltage can your tape do? Capacity,
it's
put a
a-
number to it.
Okay, I could say 600 to 800, but it's gonna change based on the temperature and the
600 to 800 amps.
amps. But that's 120. Yeah. It's high, but it's it's always gonna change for higher magnetic fields and then higher temperature as well. So I think just to know that
And at what volts? How many volts? 800 amps.
that also depends. I mean, we don't really put that in the metric as well with that, but yeah, very high performance.
It's just, you get a sense for it. This is some really cutting edge stuff.
Yeah, I mean, I think everyone here has, their competitive advantage when it comes to their landscape. So you have to look at what that is, and is that exactly what you're selling? Is that what the customers want exactly? Is that the solution that you can solve for them? So in that sense, we went to so many different people. We went to nuclear fusion, transmission, but also motors, and also MRI with GE Healthcare, NMR, magnetic resonance. And we soon found out that the OEMs like GE Healthcare, people that make motors, they don't really need such high performance tape. They're doing completely fine where they're at. Even though, we can provide all these benefits for them, they don't really need this. They don't need such a high performance, high throughput. It's really necessary. So we decided that we want to adopt a beachhead market. It's going to be for the people that really have the greatest benefit from using our products. And that was going to be nuclear fusion and transmission. Yeah, there was less urgency. There was less urgency for the large OEMs for like, Tico Westinghouse and motor guys. So yeah, we switched our shift after all this customer discovery to mainly go for the high throughput and the low cost. It's obviously beneficial that there's a high performance increase, but that ended up not being the main priority that we decided to target. We decided to, yeah, allocate resources more towards, decrease the resource allocation for MRI and NMR. A lot of times investors like to see a stable market that you can also supply to. Nuclear fusion is kind of, still in the prototype era. And if someone wants to dish out $5 million to you, they want to bet it on something that might not happen. But at the end of the day, this only is going to happen if you can provide them with high quality tape at a low price. So that kind of made to where the MRI and NMR, the motors and all the large OEMs is kind of they're going to fizzle out and eventually they'll buy. But
I think the actual is Thursday. You need 20,000 kilometers of tape per reactor.
for a prototype, yeah.
Can you imagine 20,000 kilometers
And
of tape
I'll
for
tell you
one
what.
single reactor?
I'll
That
tell you-
was a mind-bending data that Venkat gave us at the table.
The global supply is only a few thousand kilometers.
Yes.
You can't even make a single reactor right now. So yeah, all the high performance is cool and all, but you need to get the tape in the hands.
That's
of
why I brought up that blew me away when I heard it on Thursday.
Yeah, the market's economizing to get more tape in the hands of more people.
And you can also relate to why he could see the pivoting,
Yes.
that supply chain, domestic supply are critical.
Customer
When you have
discovery.
only about 2,000, kilometers available, what will be my biggest nightmare? I really make all these changes, start my project, and I don't have the tape.
Right, exactly.
So it's obviously all your properties. Yeah, I understand. You don't have to sell me. The door is already open. Tell me about other things. They're pushing on an open door.
Yeah,
On
the customer
performance.
discovery was just data collection, and it was just data collection, really, like,
In a disciplined way.
In a discipline.
right, yeah, just going through as much as we can, get as much data as we can, and kind of adopt our strategy based off of that. It's a very academic way to think about higher performance is better. You always want to target high performance, but when you think about things in a business sense, you have to decrease costs, you have to increase throughput, stuff like that. Get as much product to the customers as much as possible. And that was kind of our process. That was kind of the shift in strategy, and it's gonna work out.
Great.
Yeah, thanks.
We did not mention something that would be very useful.
Please.
There are 3 levels of people that they interview because purchasing agents will look at a different way of articulating what is critical for them. Middle managers, people who are really managing a business, they will look at it differently. And people at senior levels, they look at it on a strategic basis. He did have a good sample on all. Because when you hear something, is this universally true? Are there other things? How much do I trust this guy?
Right.
So you may want to allow.
Are efficient also. Obviously, nuclear reactors like energy, or Constellation Energy. Would they be a prospective customer?
Yeah, Constellation Energy. Yeah, I want to touch on that real quick. When we talk to companies like Beer and Transmission, and then Commonwealth Fusion and Commonwealth Energy in the fusion space, we didn't just talk to okay, let's say you talk to a scientist. The scientists, they're just gonna put in an order request for the tape. They don't care how much it costs, right? So they would care about the higher performance. That's one of the metrics we had, but that's the only thing they care about. When we talk to national labs, they have a huge budget, right? And they're willing to spend whatever on the tape because, all the developmental, it's not like a consumer facing product. So they will just buy the higher performance tape. But when you talk to people in procurement at the same exact company, they don't care about the performance. They just want the higher throughput or a lower cost. They just want higher throughput. Then when you speak to senior people, they just want the lowest cost. So you kind of get, you need to diversify the people you talk to in the same organization to really target the entire organization.
2 questions for you, Fumi. So what is the price point you're getting at with the new pivot? Like, what range would your customers pay you? How do you price that? Is it by the kilometer or?
Yeah. So it's gonna be by meter and even though it's a very CapEx heavy space, you can and qualify the cost as well as in terms of capacity or dollars spent per capacity, and that'll get dollars per meter for your costs. And then we're just.
So are
pricing
you
on
expecting
market.
your customer to pay you for the CapEx to produce the tape?
No,
So
absolutely.
you're gonna produce it regardless, and then once you have it, there's a product you can sell to them
Right, per meter. Yeah,
per
dollars
meter. Second question for you, all the money that you're accepting so far, how does that limit you to go to new markets, like another country, for example? You've taken a lot of US dollars
Right.
in grant money.
Right.
How does any of that limit you to go to another country? Because now this is, we talk about nuclear, it's almost national
Sure.
security, right?
I think it's
Great
actually
question.
more of a blessing kind of, in a sense where we're in a very special market where there's literally no strong domestic supplier right now. 95% of the tape only comes from China and Japan, and they mostly serve those markets. It's gonna be extremely difficult for a US, no matter what you're making, it's gonna be extremely difficult for you to tap into the Chinese and Japanese market because they're supplying most of it right now.
What are you
Yeah.
do today?
I'm sorry?
They're buying with 100% tariffs.
Okay,
They're buying, there is one domestic supplier in the US and it's low quality, it's very low quality tape at a high price.
okay.
The good tape is coming out of China and Japan, but you have to pay huge tariffs on it. Takes a long time to get it. There's gonna be, barriers in communication. So the market is looking for a domestic supplier. So you need to fill that gap. There's always gonna be gaps in the market. You just do the glue.
Okay,
It's a great unfair advantage.
so we're gonna have to see
Yeah.
on November 15th, your pitch.
Yeah.
Yes, with the 9 components.
I have a question out of curiosity. I'm just asking, how many entities are currently working in this nuclear fusion thing? And how your work is being implemented in this?
There's just two different ways of doing fusion. One is using magnets, it's a whole actual reaction, and then one's using lasers. I don't know completely about how that works, but the one that uses magnets is probably on like 10 to 8 to 10. 8 to 10. But the global capacity for one unit is so high, or the global amount of tape needed for one unit is so high that all these companies have raised money, they just need to build a magnet. They need to build a prototype before I.
And they're calling it nuclear fusion.
Fusion. Yeah, compact fusion.
Where in
But
the,
they're not really, it's not really fusing atoms, is it?
It's a different thing.
Fusing
Yeah,
atoms.
it's fusing helium and
where in the US would such demand come from? I'm, for some reason, I'm seeing it's not Texas. Is it Texas? Yeah,
most of it's happening at
How's
MIT, or it kind of developed at MIT, so it's happening in Boston right now. So Commonwealth Fusion is the biggest company, and they're in they're in Boston somewhere, and
They would
They
be a
just-
prospective customer.
they would be a prospective customer. They recently just sold $1 billion to E&I or any, I don't know, E&I.
The dollar.
I think it's an oil and gas company. They sold $1 billion of energy that hasn't been through it's still in prototype stage. So they're buying future energy for $1 billion. So they're getting money, they're getting orders, they need to make something happen, right? So,
Well, between Bitcoin and AI, the energy needs in this country are through the roof.
Yeah.
Yes.
yeah. And I mean, energy is also, I mean, the devices are getting to be more, but not just sheer number of these devices is, so it's, someone can argue that, hey, you know what, this is much more efficient today. But I now have 100 of these.
Yeah.
Compared to 10 years ago.
Yeah, but that's minuscule. It's mainly
Oh,
those data
times-
centers
Yeah.
for AI and Bitcoin that are just so, one of the biggest issues in the New Jersey governor's race is the price of electricity. It's gone up 25% in the last 1 year, and it's all driven by these data centers.
I will say that none of this would have been at the point of where it's at today, maybe 5 years ago, because compact fusion completely shifted the market for HTS. Before you need 20,000 kilometers for a single unit, you need maybe a dozen kilometers for the whole market. You only need a few hundred kilometers for the whole market because these people do these little science experiments. Nothing really consumer facing, nothing really that is the main component in a consumer facing product. So the market's always gonna shift and you just have to adapt with the market.
We'll wait to see his 10-minute pitch, crisply, 9 components of the pitch, 5-minute Q&A. But you've gotten a good dress rehearsal for it.
Yeah.
Trent, could we get the other one back and maybe we'll take a 5-minute break?
Yes, let me just say something. We're all focused on fusion because there is a lot of excitement, but it is also much further down, lot of risks involved. People are investing because the price is very huge. But the other one that I hope he will talk and his pitch is all on the other application that he is seriously looking at, which is on power transmission and in data centers. It is markets that we know, markets that exist, not like markets that are going to happen. These are markets that, how do they think about, how are they pitching into that? Would be very interesting because that is near-term cash. That's the long-term pie that you're after. And so he'll probably describe that. When is a good time to ask some more questions? Do you want to wait him right now? No, not on him, on your presentation.
Sure.
Or should we wait for this one?
No.
And then,
Well, this is, what I'm going to do is run him through a real life case study of how the financial model is built. What are the pieces you can use? I mean, this template you can use, almost every one of you. That's folks, you might have to use it slightly differently, but there's 3 pieces to this. There's the product, there's the consumables, and there's custom.
so let me say my questions. You don't have to answer them. Maybe the example can,
That's okay.
you can illustrate. One of the things that all of these, all the teams are struggling with, how do we estimate that capital cost? Because that's one of the starting points.
Yeah.
And in some cases, you don't even have a basis. Some cases you have a basis. Anything that you can shed light on that. Things like regulatory costs, you said that can be pretty serious.
Mhm,
How do we even estimate something like that, a component,
mhm.
rather than assuming it could be 0 or 200? Sensitivity is important, but is there a starting point? Then, do we ever worry about what are the benefits that a customer is going to get? And as such, think about price from calculating backwards. If the guy is getting $5 of benefit, maybe he's willing to pay $2.50 to me and keep 2.5. Is that a good way to think
Yeah,
about
that
it?
could be, that's all flushes out in the customer discovery process.
Hmm.
Which we talked about, we had 2 lectures almost on it, and then the MVP. And being able to trial it, going from prototype to pilot to production. So let me answer your first question on how do you estimate the CapEx and how do you estimate some of these other? Estimating the CapEx is oftentimes a crapshoot. You usually get it wrong. But if you've got people who you can lean on, your professors or people in the industry, can be your advisors. And I mean, that's one of the things that we were talking offline rather about. Your tech transfer group should have access to experts. I mean, that's what happens in incubators. If you go to the ION, which is the Rice University Incubator for startups, not only Rice startups, any startup, you could go there and get yourself a desk or an office. You have access. In the ION are VCs, in the ION are lawyers, in the ION are regulatory people, officing there as part of their give back. There are people like me who are not in the ION, but a phone call away. There are people like Ravi. So you lean on them, but you are the ones who know what your product is and does, and you probably have the best idea of what the CapEx will be, particularly given how easy it is to find information through ChatGPT or Google to find out what's the cost of a 3D printer. If you want to 3D print the cover case, what's the more? Find someone who'll make it for you, outsource it. We're gonna go through that with WCB Robotics right now. In terms of what is it going to take to get regulatory approval for someone like the medtech business, not a problem. It's FDA, it's 510K, you predicate, and they need some political trials. maybe some animal trials. And all of those sort of templates exist. And there's only one sure thing about the answer, it's gonna be wrong. But it's going to be the process of getting there that teaches you what the hurdles are. And then finally, what was your last question, Radha?
No, this is about, you did answer that on terms of, when you are trying to price a product. Many of them go through this and say, well, today it is, the customer is going to see so much benefit. If I just took half of it, some number of it, and then just say, based on that calculate, I think I can price.
Well, we'll do a little bit of this over here on
this
how we
one.
priced it here. Well, I mean, we're gonna sell it for $30,000 on robot. Why did we come up with 30? Shouldn't it have been 50? Could have been 20? We could have afforded both numbers. But you do a balance between you are not an incumbent, you're displacing entrenched incumbents. You're displacing entrenched methods, and yours is you're evangelizing a brand new way of doing something, like in Nigeria. So you've got to balance that. I mean, let's go back to lecture number 2 when Alex was here. Remember Alex, everybody? The German fella? He's charging $2.5 million for his laser machine that cuts the semiconductor wafers that have 500,000 wafers on it. Now, the current methods are a diamond tip saw that has a wastage rate of 5 to 10%. So you can calculate the cost. He did. So that's a $30 billion a year cost to the industry. Now the diamond tip saws cost about 500,000. His cost 2.5. But when you factor in all the waste, when you factor in the speed of cutting, when you factor in the reliability, he calculated that within 2 years, it's customer payback and profit. So that's the way they came up with 2.5.
So that's what you meant by the process.
The process, customer discovery, getting the feedback, seeing the competitive landscape, who you're trying to displace, the entrenched incumbents. In the case of WCB robotics, they're replacing humans hanging from ropes with buckets and squeegees. That's who you're replacing. So you've got to balance that. And then if you are a brand new entrant to the market and there are these 800-pound gorillas that are dominating the market, you may want to come in at a lowball price to be a disruptor, to gain some traction, to gain a foothold, and then raise your price. So there are several ways of doing it. And some of it comes from just beating your head against the wall and getting hurt. And some of it comes from asking others. Don't feel shy to reach out for help. What's one of the Ashokisms I gave you in the first lecture? No, don't learn from your own mistakes. Learn from other people's mistakes before you make them. So reach out and get the advice, get the help. If you've got issues on how do I price my product, I mean, you got a lot of people. You did a very sophisticated, thorough way of coming to how you price your product through customer discovery. That's the best way. And in his case, there's a demand and there's not enough supply. So you pretty much have some leverage in pricing. But in your case, I don't know. You're going to have to sell these power producers on payback, right? Because you're saying it's saving them 11% a year. Yeah. And how quickly would 11% get them their 2 million back? And is there any benefit to carbon capture? I mean, do you get carbon credits for putting out less carbon into the air versus diesel?
Yeah, but I've not put that in my.
You should do an alternate. You should do, here's the base model, and this doesn't include carbon credits, but if you include carbon credits, look at the upside. You must do that. In fact, next week, we'll see that. Yeah, Kumi was our guinea pig this week. You're our guinea pig next week. So when we look at this company, WCB Robotics, they came and competed in the Rice Business Plan competition in 2018, 7 years. And at that time, they were just, that's it, all right?
Mhm.
Yeah. So what we're gonna go through is their financial model bottom up. All these are the various elements, and we'll go through each and every one of them, their detailed spreadsheets, to see how we can. We'll first look at, he calculates the cost of building this robot. This number has changed over time because we went from 3 wheels to 4 wheels to 6 wheels. One fan and 1 suction cup to 2 fans and 2 suction cups. From 1 battery to 2 batteries. From water and soap, the water, soap, filter, squeegee, and aspirator that are reused. So you can see how over time product change. So the estimate of COGS, you all know what COGS stand for, right? Cost of goods sold. That's the raw cost of the product you're trying to sell. In the case of software, your gross margins are 95%, but the biggest cost element is all the R&D it took to get there. And then we look at sales forecast by market. We look at the modeling of the revenue, the modeling of the P&L, the balance sheet, and the cash flow. I think of all of the 3 items that are there for P&L, balance sheet, cash flow, P&L and cash flow are more important. Balance sheet is good, rigorous financial discipline. It also allows you to control your CapEx and your asset base, because you don't want to get too asset heavy as a startup. That's not good, unless you've got, the US government giving you all kinds of money to buy stuff.
When you talk about staffing assumptions,
Okay.
When you have not been in this kind of a business, how
Mhm.
do you really know how many people which would be
How do I play the video?
initially apprentice here?
I can help.
I will show you how it works. Very fascinating. It went away. Went to the browser. Where's Trent? Trent.
Outside.
I think when you said the 5-minute break, he actually took it. The rest of us.
Oh, he came back.
We came back to the correct one.
Came back and then you lost it. Go to the Zoom.
Okay. It looks like the way we got this. There we go. What we want to do is capture.
Yeah, there you are. You're on the right one. So while we are waiting on him, it is these little details like number of, you just said sales force.
Mhm.
How do you estimate? Because some of these things they struggle with because of a lack of something. They just put it and put a number.
Mhm.
Any ideas on how they should think about it? Options that they have to think about
You have to figure out as you go what it takes. There we go.
Let me know when you want.
Yeah, play.
Okay.
it. Yeah, play it.
Sickles, wheels are tracked, go back over. And just using soap and water that's being sprayed. And then aspirated, so not a drop of water falls on the ground. Goes all the way to the top. And clean coming down as well. Then put it demonstrated, that's what we work around. Go to the left and right, yes, or any which way you want. And this model does not have autonomous AI built in. The production model will have AI based, so that you don't need an operator. It learns the building. Okay, that's it. Enough to show. Go back.
Just curious, has there been any case where it fell off the roof and
Never has. My point is that it has. I call it re-engineering Bernoulli's principle. They've got two suction fans. And it's about that far away. The only thing that touches the glass are the wheels and the scrubber brushes and the squeegee when it squeegees off the. As an engineering project, it's astonishing. We've never done this before. All of the robotic devices that are out on the market are 150 kilos in weight, need special guide rails, need big water hose connectors. And if you're 80 floors up, how many tons is that water hose? I mean, just the water hose connecting to that has got to be several tons in weight. So robotic window washing and cleaning is really doesn't exist. So they are a disruptor. And the technology is remarkable. They've done all sorts of great things. And we'll go into the first thing we did in financial modeling is calculate the cost. And calculate the cost at low volume and at high volume. So what you do is, and then you have somebody in your group who gets on the phone and looks at all of the various supply chain and asks them quotes. It's okay, if I buy 10, what's my price? If I buy 100, what's my price? So that's why you get the two columns. Starting with all of it, and a lot of it is 3D printed. Almost every part that you see in there, other than the motors, the brushes, squeegee, water bottle, and the filter are 3D printed. The filter that takes out the junk from the soapy water and recirculates it. And the batteries. The batteries are a whole bunch of 18650s, 30 of them in a little thing that you just plug in. And when it runs out, you plug it out, you take a fully charged one that's sitting in your truck and plug it back in, and away it goes. The new A. So the first thing you need to do for all your products is have this sheet, calculate this. What is your cost? Now, you probably get it a little bit wrong, but look, my point here is at low volume, they figure it's going to be about $6,400. At high volume, coming close to 4,000. I think maybe it'll even be lower than 4. But for now, this is a real good basis. We're saying, okay, every time I build one of these suckers, it's going to cost me $6,500. And in it, they've even included the cost of a specialized custom-built carrying case for shipping. You can see the second last line there is carrying case. So that it has to be, it's a huge suitcase. And it sits in it with cushioning and custom design interior so that it doesn't break when shipping. So first thing you do is you calculate your cost at low volume and at high volume, which is what you've done, right? You guys have done that. And anyone else done that? Have you done that? Your product? Pardon? Then you figure out what you can price it for. And this is the discussion we had where you say, all right, this device can clean 4,000 to 5,000 square feet an hour. A human cleans 500 to 600 square feet an hour. Because don't forget, it takes a while for the human to put up an A-frame rigging on the top, attach the gondola or attach the ropes, the motor, and then lower himself down. And then when he gets down to the bottom, he's got to get back out, take the elevator, go back up to the top. So he's not cleaning all the time. So we figured out that at $30,000, the payback is between 4 and 9 months. And it should be compelling enough from a cost point of view to convince people to give it a try. Just to try, because again, your question is right, will it fall off? Now for that, they've developed one more feature, which has really got nothing to do with the product, but only to answer the question, is a smart tether. So you will anchor it from the top with a tether, not to control it. It'll be slack. But as it moves up and down, the slack will increase. It'll just have enough slack so that if it does disconnect, it'll only fall like a foot. And the reason for that tether is the regulatory requirements from safety municipalities.
If it fell off and it hurt someone, that also could be.
The tether would hold it.
It will not fall off. It will not fall off.
On someone.
Just like those who are doing rock climbing, they always have a tether.
But what if they have?
That's the.
Well, people
Insurance.
have fallen off.
Yeah.
I mean, we have a full deck on WCP where we show photographs of people dangling 43 floors up with the gondola completely disconnected and the fire department couldn't get to 43 floors. They had to break the windows on the Heinz building in New York and so, and anyway, when people are cleaning, the portion beneath them is cordoned off. The same would happen here. We'd cordoned it off. But so far, it hasn't fallen, even without the tether. And with the tether, it goes to 100%. Right now, we're saying it's 99.9, but for safety regulation, sometimes 99.9 is not good enough. They want 100. And with the tether, we give them 100. So that's how we came up. And then we said, all right, it's going to be very difficult to support this product in markets that are not, this group of 20 engineers sits in India, in the city of Hyderabad, which is a very central city. And so you can support it in India from the main customer service and spare parts and training. You can support it in country. But what about Dubai? What about Sydney, Australia? What about Cape Town, South Africa? I mean, we've had requests for the last 5 years from all these markets. They're all waiting for this product. Germany, in fact, they're going to be launching the product on the 18th of November in Frankfurt, Germany, in a big trade show. It's going to be the first public unveiling of the full product, hopefully.
This year?
Pardon?
November?
Yeah, November 18th. Well, we've been closed for a year. So to motivate a distributor to pick it up, you need to give them a big discount. So our price to a distributor, let's say in the Middle East, would be 18,000. They get a 40% discount to be able to sell it for 30, or maybe they sell it for even more. Now, we've also built software into this thing where you could sell it for so many dollars per square feet, I claim, because the device measures exactly how much you're cleaning. So you could say, okay, a human costs you $50 for every 100 square feet. We'll charge you $20 for every 100 square feet. For one replace. So the distributor can model his pricing based on their market needs in Saudi Arabia or Dubai or Abu Dhabi or wherever. So that's the process we've gone through, rather, to answer in more detail your question from before. How to come up with the price. Now, we may get in here and say, geez, we're giving it away for 30 grand. We should be charging 50. And we have the chance to do that. Or we may get in there and say, nobody wants to buy it for 30. We're going to have to bring it down. Okay, that's also, after all, we're entrepreneurs. We know how to pivot. So that's the approach to pricing.
I guess
And
the
this is
other,
all what you should be doing. You should be, I mean, you'll get a copy of this, but you should be modeling it out in that way, a price by market. But yours is, maybe you've got the Lagos market, maybe you've got Abuja market, maybe you have a market up north, which have different characteristics.
I was gonna add that
Port Harcourt market might be completely different from Lagos.
That's where I'm from, by the way.
Port Harcourt?
Yeah.
So you're Igbo?
No.
No,
There are more than 3 tribes, so like 600 and something tribes.
I know, but the three, Hausa, Yoruba, and Igbo.
Yeah, I'm neither.
You're none of them. Okay. See, I know a fair bit about Nigeria.
So I guess I was gonna say, the good news here is if once you bring it to market and you had a distributor that's using it, you could always upsell them with a version 2 that does more. You could, do swarms and,
Yeah.
that-
No, absolutely.
you could do a lot more on pricing.
But
later.
then the key is that also those distributors that have been faithful and supportive of you through your tough years, you want to keep supporting. So you don't want to go back and say, we're going to screw you and raise the price 30%. We're going to stay with them. And then maybe when we go to different markets or somebody else wants to come in, then you change the pricing. Because you want to also build customer loyalty. I don't want to be changed to Al Dunlap. You remember him? He was on the cover of Time magazine as being one of the most brutal CEOs to fire. It was called Chainsaw Al.
You had earlier.
Or I don't want to be Donald Trump and stiffing my customers.
In one of your earlier lectures, you mentioned about the fact regulatory aspects.
Yes.
This one, the local municipalities will have to.
Exactly.
Does that work to get the approval? Is it the distributor?
The distributor.
Okay, so
In
that-
India, it'll be us. Eventually, when we come to the US, we may have to look at making it here because tariff is 50%. And all of a sudden that $6,500 cost goes to 10 grand. And maybe because of the comment I made, the tariff might go up. Out of retribution. So. Yes, every market will require, now. Some of the markets don't require it, like in India, I don't think there's gonna be a lot of people say, we need this stamp of approval, whole theory of bakshish in India works. Nigeria too, I know. I know. And you have a lot of skyscrapers in Lagos.
Really?
Maybe you can switch and do this.
Yeah, you will. You can become the first distributor in Nigeria.
So the next thing you do in building a financial model is going for staffing. What are the people you're gonna need? Now, you're guessing, and one of the things that most people make mistakes on is the magic of January 1st, I call it. That when the new year starts, all of a sudden people show up on your spreadsheet. It's not that easy to go from 5 R&D engineers to 10 from December to January. You've got to be reasonable about how you can ramp up, and the difficulty of acquiring people is always there. So just saying, okay, I'm going to be 50 people by January 1st when I'm 20 people now is illogical. So you can see here the various staffing, the actuals for 24, actuals for 25. Most of them you can see are in R&D, but then the other areas start to grow. G&A grows in 26, sales and marketing grows in 26, and manufacturing also grows.
How much of this details was available in 2018?
Zero.
Yeah.
This is all driven by,
Yeah.
No, the reason I'm asking is they are in 2018.
yes.
And so how much do we have? And then how important
Well-
is the lack of that information?
Well, I had them for 3 months before they presented, and I coached them. And when they presented it at Rice, they had the rudiments of all this, not to this depth, but the rudiments. We had like a staffing chart. We had 3 people today. By 2020, we intend to be 15. So we had staffing, but not at this granular level. But that only came after they joined and got coached. They were two students with a dream at the time. And that was it, 2 students with a dream and a working prototype that they built in their lab in BITS Hyderabad in the university. And they own the technology free and clear. The university said, you can have it. We don't even want a royalty. We're just happy to see one of our boys do well. From staffing then, you go to the expense of staffing. Now that's an eye test, but it's for you to look at later on when you look at it. But you take every person and then you calculate what it costs in dollars, what it costs for them for travel. All of the sort of components you can see are on there per person, per category. Rent, that's in the G&A, travel is more in sales and marketing. See that? Have any of you developed something like this? If not, it's time to do so if you're getting serious about raising money and serious about building a company. You don't build a company by just saying, I'm going to build it.
Why is there entertainment?
Taking a customer out to dinner.
But there's no sales staff yet.
There is. It shouldn't be. There's entertainment only if there are people there.
What was the question?
Why is there entertainment?
Yeah, there's a row for entertainment for every market. And it's not that much. I'm just wondering. 'cause
Sales and
for a
marketing.
Startup, I mean.
Yeah,
And
why
that's-
is there an entertainment?
Yeah, there's an entertainment row for 2024, for India, for example. It's $1,500.
Yeah,
So that doesn't mean only just, I'm just assuming, you know, in every business.
I mean, when I go there, I buy them dinners.
Sure.
So you have to have certain
Sure.
amount for.
I mean, I take the
Taking
team building
customers out.
events. They go out on picnics. I mean, they're working 60 hours a week. So it's important to do some motivational stuff for them.
Mm.
It's a strong team.
And this is staffing
In
expense.
Houston, Texas, you have to have a large entertainment budget. You don't get to do windows in downtown Houston if you don't entertain the management companies.
You got that right. You got that right.
See, that's the, you don't know what is the entertainment that company is doing with its employees. We don't entertain
It's all
them.
about customer.
Yeah,
I'm
no,
sorry.
there, yeah, you gotta take the building manager out for a nice dinner.
That you do. That's the
Or
kind of
maybe
thing.
get them seats at the Astros ball game. Yeah, all of that's part and parcel of selling. So you take that staffing headcount and explode it into something like this to get your, and look what this becomes. This is not just a financial model and projection. This gives you your business strategy. Tells you, I need to hire a salesman for Australia in middle 2026, or I need to hire a salesman or customer support person for Dubai because my distributor is up and running by then, and I need to either get him out of Hyderabad or locate him in Dubai. You know, these are decisions that this sheet, the last two sheets, forces you to make. Otherwise, you're flying by the seat of your pants.
You generally find VCs. They are, when they see this kind of detail, is it one of, gee, I'm glad that they have thought this through? Or is it one of, oh, why did you spend so much money on this? That's not the number. We don't pay that kind of money. What kind of reaction do you have? And then how do you react to it?
One word answer, yes. Both. You get both reactions. Oh, I'm glad you thought it through. Gee, that number looks strange.
Yeah.
And then you have an opportunity to discuss, which is great. You want to engage them. Otherwise, you know, you get up there for 10, 15 minutes and they say sayonara and you don't get the deal. But this sort of engages them. And then you can have a rational discussion saying, yeah, we want, the reason we have that there is because the distributor in Dubai is going to need support. And he's going to start with 10 machines and, you know, this is just early production and we might want to have someone there to do repairs, fix spare parts, do some training. That's the kind of discussion that can go on. And then the guy may say, look, that's too early. The investor may say, VC may say that. You can always go back and forth. But the very fact that you have thought it through impresses.
And engages them in a conversation. That's the key.
Then you have, this is, they say in Hindi, tukka, right? This is guesstimating. You have to guess at what you're gonna do. This is the hardest part of any financial model is, without history, what do you think your sales are gonna be? Now, they've had history for the last 5 years with people calling up and saying, when are you gonna be ready? When are you gonna be ready? We wanna buy some. So there's that history, but once you start shipping and delivering, are these real? Don't know. So what you do is you do a pessimistic version of this and see how you end up. And
Has the company done any purchase orders or taken any like pre-revenue
No.
or?
I refuse to let them
Fine.
because we have to finalize all the safety.
Hmm.
You do not want to be shipping stuff that falls off the floor.
Or for taking money up front? to
Well,
deliver?
we were okay with the money, with cash in the bank. We went out and raised another round 4 months ago from the same existing Goose investors. And we have runway till the end of next year, the end of 2026, cash burn runway. We're burning 50,000 a month. and we've got $1 million in the bank.
As a VC, how do you feel about Kickstarter and Indiegogo, these crowd-funded, that, you know?
I don't know how they work. I mean, I don't know of any serious technology company that got going with Indiegogo or GoFundMe or, I don't know. Maybe they are there, but serious companies need serious investors who bring not just hard capital, but soft capital, which is connections, advice, network, all of the above. So those numbers you saw on the previous chart, which was units, consumables are like a filter for the water and batteries and spare parts. And we end up with a business of about $50 million by 28.
Got a question on the Zoom, should I?
Yeah, please.
Okay, Ram, go ahead.
Hi, my name is Ram Karnati. I'm a resident of Katy, Texas, and thanks for the lecture. This is amazing. I have been joining since last week. We are a company that's focused on building MVPs, digital MVPs, for mid-sized enterprises, especially when a company is crossing $100 million in revenue, but somewhere under $300 million. They do not have the internal IT technology staff or innovation staff to build new products. They're profitable with their core functionality, but to catch up with competition, they want to build a new product, let's say. So that's where we come in. We take their ideas, especially we work with CXOs. We take their ideas to a minimum viable product in 7 to 10 days. And then within weeks, we build a full product they can launch to their beta customers. We have been we started end of last year. We have been able to do decently
Is there a
so
question,
far.
Ram?
Yeah, so the question is, we have exhausted our word of mouth marketing, which has been bringing us business so far. So you have mentioned about the soft capital that investors bring in. We are not actually looking for money, hard capital, but we are looking for soft capital. Do you think is that still a good idea to look for fundraising, given that we are looking for soft capital mainly?
Well, it's a complicated answer because I don't know enough about the way you're set up, but if you don't need the money, I wouldn't go looking for money to dilute yourself further. I would go to conferences. I'd go and join networking organizations like TIE, and spread your net there. I would also go and do a PR campaign, a highly targeted PR campaign to your potential customers. I don't know exactly what they are for now, based on what you've said. I think it's all high tech, deep tech kind of customers. So they should be relatively easier to find than if it was B2C. And I would, that's what I would, off the top of my head, that's my advice. But, take it for what it's worth. It's worth what you paid for. Zero.
Mm.
No, that's, I was a little flippant about that, but that's the way to do it. I would say go join trade organizations, industry-specific organizations that you can network within, and go join, and then go with a highly targeted PR campaign. Not advertising, but PR. Does that make sense to you, Ram?
He's unable to mute. Let me help him.
Does that make sense to you?
No, I agree.
Yep, it does make sense. Thank you very much.
Okay, great. Right, moving on, you can see that, and this estimate was, when I said it was a dukkha, it was a relatively conservative estimate. The optimistic estimate has us at $100 million by 2028, and the pessimistic one has us at $30 million by 2028. All very profitable, because the gross margins on this, if you remember, the price is 30,000, the cost is 6,000. It's a pretty nice gross margin. And so here is the pro forma P and L. You can see that it's about and it's too aggressive even on the cost. The cost will be higher. We're not going to do 50% net income, but even 20-30% would be huge. So all of those previous spreadsheets flow into this one. The revenue is on the top line, you can see. And then all of the costs, the staffing costs, the travel, the entertainment, the depreciation will all flow into this, which becomes the single most important spreadsheet an investor wants to see. They want to see your pro forma P&L. They want to see the assumptions that back it up, like the tukkas, and play with those. So in a really serious due diligence, they will say, okay, I'm going to take all their sales numbers and cut it in half and see what happens to the numbers. I'm going to take all their staffing requirements and double it because they've been too conservative in how many people they and see what happens to the numbers. But there's a basis for it. Otherwise, it's just wet finger in the air.
Should they include anything from the grant monies and the other monies they've got, or
They didn't get any grant money.
well, not this company, but the guys here? If they've got money that wasn't part of the income statement.
No, of course, that's
Where
in
would
your
they-
cash flow statement.
That'll be on the cash flow.
That'll be on your cash flow.
What about the 8 years for this company?
Well, they have all of their cash. When you see the cash flow statement, this is the balance sheet, which shows all the assets. And then when you get to the cash flow, you can see investments received. That is from the bottom is like the sixth line. 1.37K before 2024, and then 900K came in 25. Actually 1 million, so then they're off by 100,000. And then in 2026, we don't intend to increase any more investment at this rate, but in all likelihood, we'll go out and do a Series A in 2027 of about 10 million. Kumi.
Do you know what depreciation method they used?
Well, yeah, depreciation's flat line, depending on the asset. For the 3D printing tools that we bought, it's a 5-year depreciation. For the robotic arm, it's I think 10-year. It's based on the accounting rules. You depreciate it exactly for the GAAP. This is a US-based Inc., Delaware C Corp. So you have to use GAAP-based accounting rules. In India, when they submit the Indian operation is a private limited wholly owned subsidiary of the Inc. Their accounting is a little different. They report it for the Indian accounting rules for the subsidiary. Then it rolls up into the Inc. Or this, which is then done per GAAP. So you have to run 2 sets of books, unfortunately. They're not that different. There's nuances.
Do you have to do that for every geographic segment or just India?
Wherever you'll have a wholly owned subsidiary legal entity. See, in Dubai, it'll be a distributor who'll be buying from Hyderabad. So Hyderabad will show sales, and say they tell them $300,000 of revenue going to Hyderabad, which then rolls up into Delaware. But financial modeling, right? Now we'll get into taxes and all of that in one of the later lectures, but this is so important, not just for raising money, but also for you. You can see how decisions can be driven by these spreadsheets. Not by the spreadsheet, but by the information in the spreadsheets. And it's good, solid discipline to do this from an early stage. And then you can see how it changes because, everything slips. Everything costs more and takes longer. Just remember that. If there's one thing you take away from these 11 lectures, everything will cost more and will take longer.
The 2 founders didn't have this finance background, so was there a suggestion to add a
No.
core team member, or was this all outsourced?
No, I did it.
Wow.
Well, but they're quick learners. They're brilliant.
And now they follow the
Yeah.
what you said.
Yeah, they learn very fast.
Yeah.
It wasn't wrong. I mean, What they're doing is rocket science. This wasn't rocket science for them. Yeah, no.
Yeah, I have a question. I may miss it. What's the product's lifetime?
The product lifetime, we don't know
Oh, okay.
because we don't have them in the market yet. We are estimating 3 years based on theoretical calculations that, I mean, these geniuses can do all that stuff. Probably longer with proper maintenance, but the guesstimate, and I'm calling it a guesstimate, is 3 years.
So the,
And 3 years working 12 hours a day, whereas human beings don't work 12 hours a day. Human beings are cleaning for maybe 3 to 4 hours a day.
so you mentioned that the company's break-even time is 2 years.
Mm.
Then you guess the product lifetime is 3 years.
4 to 9 months to get.
4 to 9 months.
4 to
Okay,
9 months.
good.
Based on 4 months in India, 9 months in expensive New York. It can clean the equivalent of 7 people. It's doing it at 5,000 square feet per hour, and people are in the 600 to 800 square feet per hour. So it is 7 times more efficient than a human. And a human being costs a lot more than $30,000. And the insurance and the liability and also all of the complexity of rigging and safety features and the gondolas or the hanging, on chains with buckets on your head.
So in order to understand the current cost, how did you get about a company that operates with human beings? Looked at their annual reports or where did you
Well,
get
no,
it?
we went one step better. We brought on board as an advisor, and now he's going to become COO eventually, been an advisor for 5 years, who ran a rope access company.
Hmm.
So we brought him on board, gave him stock options. He's been with us 5 years, giving us step-by-step advice on what happens in the real world. And as he's watched this product evolve, he got so excited. He's going to leave his fancy job in Saudi Arabia and come on board as co-CEO/COO. So
just like you guys have been doing, talking to people who are actually in the business. This is CarbonX.
yes,
That's the only way you get a lot more insight.
yeah. But also, even if you don't have the good luck of finding an individual like that, everything's available on the internet. You just ask Google or ChatGPT or Copilot or one of these guys and you'll get the answer. Now, be careful. Sometimes the answers are not correct. So ask 2 different sources or maybe 3 if it's controversial. But information comes to you. And then when the information started to get out about this product, even when it was in its 3-wheel, very infancy stage, the distributors who talk to us tell us, because they're going to go and displace human beings in Dubai or in Sydney or in Cape Town or wherever. So it's interesting, the product and the market, but the main reason I've used them as a case study is for the discipline that they used in financial modeling and how it has helped them navigate cash flow. Because till you get revenue, that's the thing. How much money do you have in the bank and what's your rate at which you're burning it up? That's the key.
Even if you are not in a startup, you're in a regular company.
Yes.
How do people run the company? It's all on basis of these kinds of numbers.
So when you've got all of that, now the fundraising, we get to fundraising real quick. So you've got to understand the funding stages. When do you need the money? How much do you need? What do you need it for? Do you need it for massive manufacturing facility, or do you need it to hire sales and marketing people, or to set up offices in a Sydney, Cape Town, and Dubai? So you have to understand the objectives, and then you have to figure out what investors would be interested in this. Now, in the end, you may not be able to be too selective about investors, because if somebody's willing to write a check and they have a nice network, soft capital, take the money. because you can never raise too much money. All of this is important. We'll talk about dilution and all of that, and I think next week's lecture. But you all understand, right? If somebody's going to give you money, they're going to want to have a return. They want to have a piece of your company. It means you will have less of the percentage of that company when that money comes in. And then the biggest challenge is for these heavy research or deep tech companies where the gestation period is so much longer. Like what's happened with WCB Robotics. We've been sitting there having invested in 2019, and it's now 2025, 6 years. And the product's not yet on the market, but about to be on the market next month. So the lead times are much greater. Six years for you guys. FDA, always long pole in the tent. You are in which industry is yours? Yeah.
Working for UH Energy.
She is the one who helps us with all
With the canvas.
instructional design.
Oh, okay. So you're not one of the companies.
No.
Okay.
She could be.
And that's Samantha, right?
Right.
Yes. The carbon capture. So have you ever thought of doing a detailed financial model like this?
We have, but there's definitely improvements that can be made. It's based right now too on a lot of assumptions.
Both of you then can present next week, your financial models. Model it after this, please.
Yes, we have to,
Because I'm really interested in you guys. It seems very fascinating what you do.
we have to revise it. I know you've presented something, so we may have to make some adjustments, but we can.
You know, what would be nice is it's not about when you're being asked to, present it. The process that you go through, you have to share it. What are some of the challenges? It's not what you put out as an output. I think that is where we can leverage, Professor Rao's expertise. I didn't get this. Tell me more about how do I get that to use. I don't know what's the cost of a diesel engine. Things like that when you ask.
Yeah.
He can share some of his thoughts. That's why this example is extremely important.
And then when you get to fundraising, there are all kinds of vehicles that you can raise the safe notes, convertible notes, price rounds. You've heard of all of that? Equity rounds. So why fundraising matters? Well, you need money. It pays the bills. Without fundraising, you don't have a company unless you're lucky enough to get big government grants.
Could you cover safe note? Because that word has been used, but do you understand what it is? What is that?
We'll get into detail.
Safe note.
Safe note, convertible note. Here we go.
Oh, there it is.
There's types of fundings.
Yeah.
Well, there's four. I've made the 3 into 4. Friends, family, fools, and founders.
Okay, that do more.
Because sometimes you have to take money out of your own pocket or not take a salary or. Then you have bootstrapping. You can do it like some of you have done, which is not raise any money. Angel investors, venture capitalists, grants, and strategic investors, like say Shell Ventures or Chevron Ventures, like David came up and talked about how they do it. Those are the basic categories. So we have the entrepreneur. You start a business and you use your money in your company. Invest your own money, whether it be from the 3 Fs or your own in your own company. And angels invest their money in somebody else's company, and VCs invest other people's money in other people's companies. So entrepreneur, your own money in your own company, an angel, your own money in someone else's company, and a VC, other people's money in other people's company. Different mindsets. And entrepreneurs, we don't need to go into this, but you're the ones that change the world. Just think of 2 guys in a garage in 1982, both with the name of Steve, Jobs and Wozniak. Changed the world. college students at the time. Angel investors, like I said, they invest their own capital in other people's ventures. They take equity positions, but they don't take management control. Their governance oftentimes, and deliver, as we talked about, soft capital. And they are bridging the gap between the founder and the VC. The 30, 40, 50 years ago, the VC, the V in VC was real, venture. Today, they are risk averse. They want to invest in safe projects where you have already validated your business model. They've moved to the right on the risk scale. And that gap has been filled by angels who are investing in earlier stage. Yeah, they refer to them as vulture capitalists. We don't have time now, but I have a good joke on VCs. I think you may have heard it when you were a student and I came to talk to you guys at U of H. And funding timeline, the stages, look, pre-seed, seed round, Series A. So pre-seed is typically the 3 Fs and grants. Seed round could be angel or very early stage VCs. Series A is typically super angels and VCs. And then beyond that, you've got strategic investors, banks, IPO, and the larger VCs.
What's your definition of angels and super angels? How do they? Is it by the amount of money?
Super angel will write $1 million check.
Okay.
An angel like Han or Tai, everybody's writing $5,000 checks, cobbling together 100,000 or 150,000, making that. A super angel will individually write $1 million check. Like I was talking about Imix last week. 10 of us wrote 10 million. Okay. So particularly in Europe, grants has become a very powerful tool for early stage companies, for startups. Alex, who you met in lecture number 2, classic example of getting their business started in the university with the 3 PhD engineers, but with a $2 million, €1.5 million grant that got them going, allowed them the money to buy the equipment. And they were being paid by the university for their PhD. They get a stipend, that's the word I was looking for. Thanks. And the funding mechanics, the safe note. It's a simple assignment of future equity. And what it means is you buy future stock at a discount when you have a price drop. So you just go in and say, okay, but I am not a fan of safe notes because it's too founder friendly. It's not investor friendly enough. Convertible notes, on the other hand, have with them an interest rate typically, and they have a cap. So for instance, what we invested in WCB Robotics, we invested the initial $2 million in a convertible note. It carried an 8% interest. It would convert at a 30% discount to a price round. We've not had a price round yet. Price round meaning somebody comes in and says, I value your company at $20 million. So we would then convert at a 30% discount to the 20 million. Same with the safe note. You'd convert at the discount to the price round.
So at that time you have to put in more,
No,
up 30%.
no. It's just that your 2 million becomes a share of the 14 million. If you have the 30% discount on a 20 million. But you have another feature in there, which is a cap, but capped. And we capped it at 5, I think. So we will convert at 5, not at 14. Because we were the early stage that took the risk. So we deserve. So we end up with, pardon?
Double coverage for you.
Double. So we get the lower off, the discount or the cap. That's a convertible loan. And a price round is somebody says, okay, it's worth 20 million and I will put in 10 million and I want a third of the company. 20 plus 10 is 30, 10 out of 30 is 1/3. Did you all get the math?
Mhm.
You got the math? 10, The investor comes in and says, I value you at 20 million, you're worth, and I will write you a check for 10. That means the total value now is 20 plus 10. 30, of which they own 10. So 10 divided by 30 is 1/3. So then they will have shares that are equal to 1/3 of the total that your company has. So if you have 10 million shares, they will own 3,333,333 shares. Just as a simple math. You all follow the math, folks? Or do I need a whiteboard? Go with the whiteboard. So those are the three typical investment vehicles for startups. Other than grants, which are non-dilutive, the grant coming from DARPA or SBIR or somebody, you just get the money. And these agencies don't own any piece of your company. And that's what happened with Alex. In the German company, the $2 million came in completely non-dilutive. So they, when Goose invested for the first time in LighterTech, the four founders owned 100% of the company. Now we put in $5.5 million at a $7.5 million valuation. We ended up with 38, 37% of the company.
So the valuation is critical at that point. And who does it? You or the investor, or is it a third party?
No, it's usually a negotiation between the investor and the founders. They have usually overinflated expectations of their valuation. The investor typically has very aggressive expectation of the valuation, and that's why it's so important for you all to have a business guy in your founding team. Alex did all the negotiating, not the engineers. Plus, you hopefully run into an investor that plays fair, that doesn't screw you. Because I could have gone much tougher on it. Now, I think I could have gotten away with taking 50% of the company. Saying you're 5.5, we put 5.5, that's 11, we get half. But it would have been harsh. And in the end, my view is 40% of a big number is still great. I don't need 50 and let them be motivated and keep 60. But not everybody thinks like that.
So what is the advice for avoiding things like that? Like,
Pardon? I can't hear you.
what is the advice to avoid things like that, specifically when, like people are new in the startup phase?
Find an advisor who will advise you. Find a mentor, find a coach. And your university. I mean, this man is a wonderful advisor and coach right here. Universities should be part of Mike's job, is to be able to create what the ION has created with the lawyers, the VCs, the IP people, to help these startups on a pro bono basis. They don't have to pay. It's part and parcel of being part of the ION, being part of the incubator. And so Mike should be thinking along those lines, I think, rather.
Any thoughts on plug and play, mass challenge, any of those other Y
Well, that
Combinator?
challenge is great. I like, but then it means you're going to spend 6 months in Boston. They make you move there. But it's great because you rub shoulders with.
Your future customers in Boston.
Yeah, what's it called?
Mass Challenge.
Mass challenge.
Mass Challenge. It's a combined project run by MIT and I think state of Massachusetts, and it's also pretty nice business plan competition followed by sort of incubation there. But
But they have an Austin office too now.
they do. Yes, they do. Yes, they do. You're right. Forgotten about that. And
Sugarland.
Yeah.
Sugarland has.
But the nice thing about going up there is you get to rub shoulders with all of those guys at MIT and Harvard and Boston College and BU and Epson. So great.
Do you have board seats at LighterTech?
Yes, I'm the chairman.
Do you have majority?
No. the individual four founders are now each owning about 10%. 9 to 10%. And all of the investors, because we came in, the first round was 5.5 and the second round was 13.
Okay. That's how it got.
Yeah, further diluted, but at a much higher valuation.
Sure.
The first round was at 7.5 million pre-money meaning before that 10 million comes in. And post-money is when you add the valuation to the money that comes in. So pre-money was 20 in my example, post-money is 30. And the second round was, pre-money was 20 something and 13 came in for most of 35.
Were you lead investor in the first round?
Both.
Okay, okay.
Both. We met both. So everything making sense to you about the fund? Because this is something that for young, bright PhDs, this is brand new. I mean, it's hard unless you have been coupled with a business person who's done it before. The nice thing for LighterTech and Alex was that he worked 7-8 years in the industry. He had worked for Goldman Sachs and he worked for PIMCO and he had done lots of deals. And without him, I think those three geniuses would still be in the lab. And then we'll talk about, in 2 weeks, we'll talk about constructing a pitch deck, the 9 components of a solid business plan pitch deck. And then the due diligence that you will have to be willing to subject yourself to when investors start to drill. Because they want to know, what's your patent like? How firm is it? You have freedom to operate in the areas where you don't have patent. How defensible is, well, that's next week. We're going to talk to Glenn. We're going to have 2 really good guys come in as guest lecturers from Hunt and Andrews Curtis. Really bright guys. So all of this is part and parcel of, and then the types of capital, if we talk about 9 dilutive, which is all those things that take share, and then debt. There is an opportunity sometimes, like when LighterTech raised their 13 million, they could have gone out and got about 3 million in venture debt, which is a loan from, they're not venture capitalists, they're venture capitalist debt lenders. So they piggyback on an investment round and saying, hey, wait a minute, somebody's done a lot of due diligence. Somebody's willing to write a big check, 13, 15 million. I'll just piggyback on them and I'll offer you another 2, usually around 20% of the round is what they will do in debt. And my view is, if it's there, take it. What was my favorite line?
Sorry?
What is my favorite line? You can never raise too much money.
There are banks that will loan you money. Where
Well,
does that
not
fit?
till you're profitable. It'd be very difficult to get a bank unless you put up personal guarantees. And young founders don't have any net worth to put up a personal guarantee. So banks are tough. Banks are great once you're making money, and banks don't like risk. But venture debt lenders will give you debt. If you have a serious fundraising round, a Series A or a Series B with a lead investor, like who's a respected lead investor, they will piggyback. Like I said, this is a little repeat, but for deep tech, the landscape is a little more difficult because of the protracted length of time for a return. The timelines don't really sit very well with traditional Silicon Valley, Cambridge, Massachusetts kind of VCs. Almost on time. So we talked about this. First thing anybody will look at is the team. Is the team capable of delivering whatever it is they say they want to deliver? Before they even think about, let's see if it's real, they want to make sure that the team is capable of delivering. Then is the technology protected? Like I say, you don't protect it with a wall. My analogy is always it's a moat. Tiles in them and moat, so that you're defensible. All your IP and your trade secrets have strong defenses. Is it a good market? have you shown some traction in the marketplace? Do you have pilots? Do you have some prototypes out there? Have you validated your business model? And is there a path to exit for the investor? Is it a strategic acquisition by a big company? Is it an IPO? What is it? Is it a merger with somebody else? So in that landscape, have there been deals done? And what have been their valuation? Are they a percent? Are they a multiple of revenue? Are they a multiple of EBITDA, cash flow? What are they? So all of this will need to be demonstrated to an investor before they're willing to write a check. And you get diluted. We talked about it. So this is superfluous.
You know, you made a very good one in the previous slide, which is equally applicable to every one of these projects, except probably for your one on software. Because, you know, if you go back to the previous slide, even though it's the last line, it looks like, since it is a long time frame, lots of risk when you're starting out. And so when he just says that,
Yeah.
you're constantly looking at, are you meeting milestones on de-risking the project? Because there is no use putting good money after bad. Just stop when you know. Stop digging when you're already in the hole.
Correct. First principle. Of getting out of the hole you've dug for yourself. Stop deep. Okay. Everything so far been hanging together for you guys?
No, let
So
me-
the trade-off in raising money externally is always founder dilution and loss of some control, because you will have investors that'll be asking you questions. You'll get a chairman of your board or something of that nature, versus being able to raise the money, getting the soft capital that goes with it. And as I said, the team is a very important part of what the investors look at, the marketplace, the product, the validation, how scalable is your business model, and what is your exit potential. Some of this is repetitive. And how do you go about raising funds? Well, you've got to have a great pitch deck, and we're going to work on that. It's your business plan. It's the 9 components of your business plan. That's your pitch deck. You've got to have great capability in Q&A, and we're going to spend some time about storytelling. That's going to be in our second last lecture, storytelling. You've got to have strong financial models that you're fully aware of. There shouldn't be a question when an investor asks, okay, now, you know, that entertainment that you're having, why do you have $1,500 of entertainment? You've got to have the answer off the top of your head in something as minor as that. Can't be, gee, you know, I need to talk to my finance guy. After all, it is your business. And then you'll get term sheets. We talked about the negotiating process and who negotiates for you and against you. All right. So I say build 3 scenarios: the base scenario, an optimistic one, and a very conservative one. Preempt the investor having to go in and change the model for you. Say, okay, here's my base model, but you know, if everything goes to hell in a handbasket, here's what it looks like. And hey, if we have a nice strong following wind, here's what it looks like. All of this then breaks down the risk of the fundraise. Don't overpromise the hockey stick. So tempting to say, I'll be a $100 million company in 2 years. Because you feel it, you see it, you smell it, but it's not real. It always costs more and it always takes long. And don't ignore the problems that regulatory hurdles create. An FDA or municipality. In your case, FERC is involved.
I don't think so.
No FERC involvement in.
No,
No,
not for-
no, not at all, because our process does not emit any CO2.
definitely safety issues.
Yeah,
That's a different thing.
so OSHA.
No.
No, not strictly.
Not at that stage, not at that stage.
Okay. So closing thought. Financial modeling is not about, you know, precise predictions. It's about creating a story that people can get their arms around, believe in, knowing that you're gonna miss those targets. But the team is good enough to deliver and can take corrective action when they need to. Gonna run out of money, had to go back and raise money real quick, what cut of costs, have a hiring freeze, everybody takes a pay cut. Whatever you need to do, whatever it takes, should be the motto of every startup.
In the order in which you showed on the previous one, it's interesting. Can you go back to the previous slide? Just, he just says investors back those who combine scientific excellence with financial discipline. The other day, we were having this conversation with potential customers. And this is an EPC company, and they were diving deep into the technical aspect to just say, does it make any sense?
Yes.
And later on, when we were showing, it will take about $1 million to develop. The guy had a big laugh. And he just said, it'll be good if I can do it in 1 million. The number should be more like about 20 million. And then I would easily believe you. So it just shows we may not be very good, but they are looking at that as well. And they don't have a good idea. That's the first
Get
one.
the advice. Get people who can give you advice. Get a guy like this guy. So yeah, it's a combination of scientific excellence and financial discipline. And the truth, as we saw in Ashokism at the very start, lies between reckless optimism and paralyzing pessimism. Chart a course in the middle, like Ulysses did between Scylla and Charybdis. That's your Scylla
And Charybdis, yeah.
Charybdis.
Charybdis, you say.
Yeah, Charybdis. That's the way
These are
Greeks
the
pronounce
two
it.
Greek mythology.
Okay, so far hanging together. This is a great example of financial discipline and financial modeling. Houston Ship Channel, 100 years ago, was conceived by Jesse Jones, and they raised 1.25 million, combination from a Houston councilman. Do you know what his name was? There's a town name for him here.
Cullen?
Tom Ball.
Tom Ball, okay, yes.
Tom Ball and Jesse Jones put together to dredge Buffalo Bayou to create the Houston Ship Channel. Because Galveston, which was at that time the South's biggest port, was dangerous. It was getting flooded every 10 years. It destroyed the whole city in the year 1900. And at that time, Galveston was the richest city in all of the United States.
Huh?
Yeah.
Yeah,
And
Galveston was.
yeah.
Actually, Houston developed only after 65.
Well, but this caused Houston to develop because of the soft capital advantages. Because shipping, and we became the largest port in the South. They built a financial case to fund a project that transformed Houston from being a small little cowboy hick town to becoming fourth largest city in a global port, second largest port in the United States. So they model not just the direct revenues from port fees, but the ecosystem value that a port of that nature would create. So part of your challenge, you have an opportunity in your business to do this.
It's a platform
To
technology.
do the broad-based vision without reckless optimism of saying, what can this be? Yeah, we're going to dredge it and make a port, but beyond making it a port, this is one of my favorite examples of wisdom, prescience, and gamble between a councilman and a brilliant businessman coming together and saying, okay, let's raise money, half public, half private, and dredge Buffalo Bayou to create a ship channel. And at that time, 1.25 million, which probably today would be a couple hundred million. And you wouldn't be able to do it today for a couple hundred.
Yes.
So we're gonna
Homework
do
assignment.
two financial models along the lines of what you saw. Please, all of you try to do it. Deal?
Yeah.
Deal? No, you're gonna do it anyway. Deal?
Yeah.
Financial model? Please have it to me before you show up tomorrow. I mean, next Saturday. I'd love to see it because I think beyond everything we've done till now, this encapsulates your business.
You know, when he gives these homework assignments, I mentioned this last time and I don't mind mentioning it again. This is not just to see how perfect you can develop something. It is much more. It's easy when he walks through all of this and you just say, yeah, it follows. When you sit down, the first line you start entering, what did he say about the categories I need to enter? And all you remember is sales, price, and something. Now, when you look at all these 16 items, it starts making you sweat a little bit, which means you're going to think a little bit deeper. You can run into problems, that's okay. But that's the opportunity to ask the question the next round. That's where learning really happens. Or else we're just sitting here warming the benches.
Correct. Now, the date is October 18 because we advanced everything, lecture number 7. But see if you can, along with the spreadsheets of your financial model, create a 3-slide pitch deck where you identify your capital needs and calendar dates when you need them, how you're going to use them, use of funds, and the cap table before and after. Pre-money, post-money. And some reading list, again, I don't know if you found the reading recommendations handy, but I think there's gold in them hills. In some of these, I do try to think through what it is that'll be useful for you all to read. I mean, maybe you can go back and read it later when you have time. And your challenge is to build the financial model that combines precision and dreams. Both. Remember, don't calculate the cost of not chasing. Thank you.
You know, the only thing that I would like to add at the end